specifically focuses on quality of earnings, buy side and sell side financial due diligence. We probably touch, I don't know, close to 60 deals a year, sometimes more, anywhere from enterprise value of 1 million up to 75, 80 million US in transaction size. EBITDA ranges can be as low as 200K and as high as 7.5 to 8 million in EBITDA. So a little bit of variation, but definitely focused on the lower mid market and Main Street businesses. Most of our deals are going to be in that SBA compliant $1 to $20 million range, with some variation up and down depending on who we work with. And so I think that the reason I say that is it's an important caveat. I don't know now the folks in this room what type of deals you guys are chasing and what you guys are looking for, but I imagine a lot of it's going to fall in that $1 to $20 million space, more likely 1 to 10, 1 to 15 for SBA, and if you guys are doing Parapasu, maybe a little bit more. But so for today, I'm going to focus a lot on the lower mid-market transaction size. How to deal with sellers, how to deal with the quality of earnings, what goes into a quality of earnings, what you guys can expect from us as the provider, and what you guys can expect as an output, a deliverable, what we look at from a financial lens, and how basically we do our analysis, and really how we kind of tackle a deal from top to bottom. So I'm going to present my screen a little bit and go through a few different things. I'm going to go through a PowerPoint presentation. That's a sample quality of earnings to show you what a PDF output looks like. And then at the same time, I'm going to draw on recent deals we've done, real life case studies, so you guys can see real life examples of, okay, how did TreeWalk analyze this deal? How did TreeWalk find a mistake in this deal, and how we really kind of adjusted our earnings? And obviously, when you're buying a business on a multiple, every kind of transaction and every sort of variation up or down in EBITDA is significant, because you're dealing with folks that are selling a business on a multiple. So 10,000 is really 30,000, 100,000 is 300,000 in enterprise value. So understanding the valuation and the impact of multiples is going to be really crucial. So I'm just gonna go through a little bit high level what financial due diligence is, and then we're going to jump into kind of a quality of earnings. So financial due diligence generally is the first service provider, I call it, the first one you pay for when you get under LOI. So usually folks, when they get under LOI, they're going to they're going to do some DD on their own, maybe spend a few days, 5 to 7 days doing their own operational DD, getting a little more information than you had pre-LOI. Once the LOI is signed, about 5 to 7 days after, you come to TreeWalk or another quality of earnings provider and you say, hey guys, can you kick off financial due diligence? So financial due diligence, really, we're in a bit of a sprint where once you're under LOI, you only have 90 days, you only have 60 days in some cases. So really, we have to move fast, and we have to get high quality information quickly and analyze it quickly. And so a big part of financial due diligence is uncovering mistakes in EBITDA and really giving you the comfort as a buyer to say, hey, is my EBITDA or is my SDE within a certain range for me to pursue this transaction? Once we finish our work, maybe let's say an average a deal is about 3 weeks to do a quality of earnings. About 2.5 weeks in, or a 3-week mark, if we're still working, generally I'll come to you guys and say, listen, I think things look materially okay. You guys can pursue legal, you guys can pursue getting started on APA and all that stuff. On the other side, if the deal looks bad, I call you guys right away and say, listen, I don't think you guys should go ahead with legal. The earnings look terrible. There's mistakes everywhere in their accounting, or we need more time. And that's where you guys can extend the LOI or things like that. If you really want to pursue the deal, we just need more time. So that's where financial due diligence comes in. It's really to uncover, what has the business been doing in the background, right? So we're looking at financial reporting oversight. So most of the businesses we're going to be talking about today are not going to be US GAAP compliant. They're very likely not going to be on an accrual basis. So we're going to get cash-based financial statements for most businesses under 10 to 15 million. Now, it's not always the case, but I find it's the case probably half the time. So understanding what their financial reporting oversight is step one. From there, we get into the analytics and the quantitative aspect. Proof of cash. Every deal comes to us, once we get the material, the first thing we're going to do is proof of cash. Like, if proof of cash doesn't work, this deal is dead in the water. I will say most of the time proof of cash does work, and it works out fine, because cash is not generally cash-based statements should tie out to proof of cash. It's not going to be rocket science. You take the bank statements and we recreate the financials. from the bank statements. The tricky part of the proof of cash is when you have significant movements in balance sheet items and you have to adjust for non-operational transfers and things like that. So that's really where the proof of cash kind of gets a little bit more granular. So you make sure you know where the money is going. The higher risk on the proof of cash is on the expenses side. You want to make sure what's leaving the bank account is actually hitting the P&L, or it's actually hitting movements in CapEx, and it's not just money he's paying out to some workers and he's not recording on his P&L, because that does happen sometimes, unfortunately. Not often, but we have seen it before. From there, probably the one you guys are most familiar with is going to be the adjusted EBITDA. The main goal of a QV is to get to an adjusted EBITDA. We do 100 things around that and ancillary to that, but the goal is let's find an adjusted EBITDA number. I'm going to go through a little bit of what that looks like, what we look for, and how we get there. Net working capital analysis. I will say probably more deals die because of net working capital than any other reason across the board. We're dealing with two situations now where deals might die because of net working capital. So understanding your net working capital position is going to be massive, and understanding how much net working capital should come with the business is going to be crucial. You're never going to, half the time I bet in the sims and things like that, the seller doesn't even know they're supposed to leave net working capital. So you're going into it where the seller is thinking it's going to be zero, and sometimes it ends up being 1.5 million. But that's a significant difference. So getting ahead of net working capital early, getting ahead of the conversations. Everyone in this room now, you've heard net working capital. You guys should be in the top 1% of small business buyers, because you guys know you need net working capital to run the business. That alone puts you ahead of most folks who go into a deal assuming there's no net working capital. I told you guys I was going to give you real life sample stories, and I'll tell you guys one now. We did a QV on a deal a few months ago where the balance sheet presented in the sim showed no inventory and showed no AR and showed no deferred revenue. It was just a balance sheet that had, I think, had accounts payable on it and nothing else. And the seller and the seller's broker said, this is the balance sheet. I could tell you within 5 seconds, if you guys get a balance sheet and it's not got AR or deferred revenue, it's going to be wrong. If there's no inventory and you have an inventory-based business, it's going to be wrong. If you see inventory that doesn't move very often, it's kind of stable month over month, it's probably going to be wrong. So right away in that deal, we looked at it. The first thing I said to the buyer was, listen, the buyer said, I don't think I need net working capital. Look at the balance sheet. I'm like, nope, you need it. Just because they don't present it to you or they don't show it on their books, it doesn't mean it's there. It's not there. A perfect example of this is work in progress. Most small business buyers don't record work in progress on their balance sheet, especially maybe construction companies might, but we're dealing with the situation now. Let's talk about aerospace company, for example. They might be getting parts, repairs. Let's say you're doing repairs and maintenance. You might be getting an aircraft, or you need to change the brake pads on it. That aircraft might take 3 weeks to 3 months to come through your door. You guys get the parts, you guys just get the labor, you guys work on it, and you guys push it out 3 months later. All those costs that are going into earning that revenue, you're not realizing those for about 4 months, right? 3 months for you guys to complete the work and invoice the project. If you guys are on net 30, you guys get paid 30 days after the 3 months ends. So that's 4 months where you've incurred all these costs and you don't have any revenue associated with it. Now that's a 4-month working capital hole basically you have, especially if you don't take deposit or deferred revenue up front. You're not pre-charging the client anything. So things like that. You're not going to see that WIP account on the balance sheet in most businesses. It's just not the case. So that's a perfect example of a situation where just because the balance sheet doesn't say there's WIP, there is WIP, right? And so understanding the business is crucial. And that goes to the next part of margin analysis, customer concentration we have on here. Margin half the time is not going to be recorded right on the P&L. You're going to be seeing a lot of folks expensing cost of goods sold items through their profit and loss. They're not going to know where to put it at the top line. They're going to put it at the bottom line. So understanding margin analysis and customer concentration. I think customer concentration in the lower mid-market is another key issue, and it's more so than in mid-market. Most of the businesses you guys are buying or looking at are going to be legacy businesses. So what does that mean? That means if you're buying a business from me, for example, and I'm selling a landscape, it's likely going to say Avnit Landscaping. And why is that important? That means most of my customers have a relationship with me. They've come through the business to me. I collect my own AR. I call them. They're my personal friends. They're contractors I've known for 20 years. So understanding customer churn and concentration and what the plan looks like post-close, that's going to be a significant hurdle for you guys to cross. If you're buying a business worth $100 million, you likely won't have to deal with that because you're dealing from business to business. But at 10, 15 million, 5 million, you're dealing from people to people. And that changes things dramatically. So I've seen deals post-close fall apart because of this. And really structuring your deal, and this is when we talk about deal structuring and tying in incentives for customers to say, having some forgivable seller note portions, getting creative when you've got high customer concentration. All of those are going to be really important for you guys to succeed kind of post-close, right? So when we talk about equality of earnings and financial due diligence, it's not just adjusted EBITDA, it's all of these other things I'm outlining as well. It's everything from a financial perspective of what can go wrong with my business and what do I need to verify, or not only verify, understand when I take over the business. What's my cash hole on day 1? What's my cash flow on day 30? Do I need to hire? Is the seller being creative with their accounting that's going to screw me up later, right? So understanding all that ties into our quality of earnings. So it's not just adjusted EBITDA, it's everything else that goes around with it. So now we've talked a little bit of quality of earnings and kind of what it is, right? Quality of earnings is really a financial focused due diligence sprint, usually about 3 weeks, where we try to identify all of these things. Obviously, we're on a tight timeline. We're dealing with older sellers sometimes. So, there's a little bit of push and pull on that. And we try to be as fast and as thorough as we can, but there's going to be some areas where we might not be able to answer. Like it's very rare you get an inventory aging report, for example. So trying to figure out workarounds and really tying stuff to source documentation matters in the lower mid market. So all of those things are important as you guys close your deal. So as you guys go through quality of earnings, this is a sample of what a table of contents looks like when you guys do a quality of earnings. So we always start with a accounting process and a summary at the start where we go through controls. We go through where is there opportunity and incentive for both fraud and mistakes. And what I mean by that is, where is there in the accounting cycle a chance for somebody to make a mistake, and that's through manual entries, that's through poor bookkeeping, that's through incorrect bookkeeping and poor oversight. And where is there opportunity? So where can somebody manipulate the books? What are the accounts that are more easily changeable? Because the thing about accounting is it is black and white in some areas, but a lot of times it's gray. And I can tell you construction businesses are a perfect example. We're dealing with a business right now, and you know what? Let me kind of pause here and show you guys a different screen. This was a real life sim that we saw for a business. We're working on it right now. It's about 2.5 in adjusted EBITDA for 24 and 1.4 for 25. It's a bit of a drop, but the TTM came in at 1.8, I believe. Now, when you're dealing with construction businesses, what's the risk? Okay, right away, I can tell you what the risk is. Accounting basis, cash. Okay. You guys know anything about construction businesses? Doing those on a cash basis for accounting, there's so much opportunity for manipulation. You invoice based off percentage of completion. This is a custom-based cabinetry or millwork business, for example. They invoice on percentage of completion. They say I'm 50% done the project, they invoice 50%. Say I'm 60%, they invoice 60%. So you can see how there's so much room there for them to manipulate their earnings, even slightly on across 10, 15 projects adds up to a significant number. And the second thing is it's cash basis. So they're recording deposits as revenue. They're recording anything they get paid up front as revenue. And all of that's going into the gross receipt or sales. So you see this huge top line number from a cash basis. The first thing we did is we took this business is we said, okay, show me what the accrual basis looks like. And so you guys remember my number right now. It was on the top line for 24 was 9.1 million and their adjusted EBITDA was 2.6. When we took an accrual approach and we adjusted their financials and this business, the 2024 EBITDA had dropped from 2. I believe it was 2.4 to 1.7. So a 700,000 drop in EBITDA in 24. 23 was an amazing year for them. So what they did was, because 23 was so great, they basically pushed some of their earnings into 24. And when they collected the money in 24, they recognized the revenue in 24 when it should be in 23. So you see a scenario where The 24 EBITDA dropped 700K. The 25 was actually very close, kind of on par to what they said on a cash basis. But now, what do you think our TTM looks like, right? Our TTMs dropped 500K in EBITDA from what they presented. And all we did was change from cash to accrual. We did so ignoring all of the adjustments we did after, all we did was do cash to accrual, and our EBITDA drops 500,000. And so that's a significant adjustment, right? So when you guys see SIMs and you guys look to acquire businesses, I think having your blinkers on early and figuring out where is their opportunity in the SIM, or where is the chance that they could be lying to me, or they could be presenting the information that's more advantageous to them. In this case, it was on a cash basis. And I guarantee you, I don't guarantee you, but I tell you, I bet the broker knew there was accrual statements, and I bet they knew there was cash statements, and I bet there's a reason they put cash on there, and I bet there's a reason they did it that way. Because they thought if they go through a process where they don't get a QOV, or the QOV provider doesn't catch cash to accrual adjustment, they didn't misrepresent their financials. They represented them accurately, but they did them within cash. And so that small annotation there changes our financials dramatically. And so they're not doing anything wrong with the way they're presenting it, but you as a buyer understanding why are they presenting it that way, and going to the source of truth. In this scenario, you know it's a custom construction and millwork business. You know they have deposits. You know there's WIP. You know there's work in progress. You know there's a retainage component to some of the work you guys are doing on these construction projects, long ARs. So having a cash-based financial statements in a situation like this it's not going to give you an accurate representation of the company, and it's not going to give you an accurate representation of results. So that's a prime example of where we went in there and we didn't do anything fancy. We just went cash to accrual, and the numbers changed dramatically. So when you're doing a QV and you have a QV provider hired, you need to ensure that they're looking at both cash and accrual financials, and they're understanding the nuances of each and understanding what the importance is of switching them, right? And you'll find in certain businesses, we're doing another business right now, they're a home staging business. So they get paid everything up front prior to staging homes. Same thing there. Once we got to accrual, their numbers dropped about 75K on the EBITDA for 24 and about, I think, 125K in fiscal year 25. Another business we're doing right now is we worked on so they do entertainment, basically. They rent out speakers and visual and audio stuff for big concerts or big projects and things like that. They take deposits up front right away. Any business that has deposits up front is likely going to have room for revenue manipulation. So certain businesses are inherently more risky than others because of that. And so I think you guys as buyers understanding that, seeing that, and looking at what it looks like from a QV perspective and what your impact is going to be on your EBITDA, it's going to be material. So this case right here, I just showed you one thing, and we changed EBITDA by 700K, and on I think it's 4.5x multiple because they're 2.5. Like, you can do the math. Like, that's a $2.5 to $3 million impact on purchase price. So very, very material in this case, right? As we go back to kind of quality of earnings and what's going to be better, one EBITDA adjustment. So going downwards as we go through this QV. 1, 2. So you guys can see accounting process. We do a pretty in-depth analysis on accounting process. So from your guys' perspective, a lot of your deals might not be this big, and they might not have this level of quality of earnings done on it. So we might just verbally go through this with the seller and we verbalize it. But in some cases, we present it if we go through a full scope quality of earnings. So you can see the reason the accounting process is so important is what I talked about earlier, right? As you guys buy a business and you guys take it over, you guys are going to need to change things. You guys are going to have recommendations for improvement. So having scenarios where we recommend improvements, where we look at earned invoices versus invoiced, it's going to be pretty material, right? And on all of our QOVs, I think earlier I mentioned we talk about sourcing the truth, right? So sampling contracts, sampling invoices, making sure what the invoice date is matches the general ledger date, and sampling high risk invoices, right? You'll see oftentimes is cutoff periods, December 31st, January 1st. That's where a lot of errors and manipulation happens, both for tax purposes in small business world and generally for accounting purposes. So a lot of times you'll see small businesses in December make all these wonky adjustments to their financials because the tax guys told them so. So when you guys are looking at a TTM period, you guys need to normalize December. I think like 75% of the deals we work on, December looks wonky in some scenario because of that. So having monthly financials is the first thing we always ask for. We have a small request list we always ask for up front, but having financials monthly, both balance sheet and profit and loss, that's absolute game changer because you guys can see in a month-to-month basis if a company's gross margin is swinging 100%, 0%, 90%, 2%, there's something wrong going on, right? And their accounting is likely not being done right. So a lot of times getting those monthlies, having that monthly view is going to be very important for us. And as we go through QV revenue recognition, this is kind of what I talked about with the deferred revenue component. Having revenue in accordance with GAAP or some sort of accrual basis, and most small businesses don't have that. And when you do that, you'll see your EBITDA and SDE often tells a different story than what's presented. So ensuring that you guys are looking at that, ensuring you guys are looking at deferred revenue and your quality of earnings providers going through all this, it's going to be material to your transaction. So as we move away from the accounting side of the business, let's talk about what can go into a quality of earnings. So you can see on this deal, we have 18 adjustments. This is a sample of a previous deal we did years ago that we like to use. So when you look at a quality of earnings, there's so many different ways brokers and folks can make adjustments that are going to be advantageous to them and kind of increase and inflate their purchase price, if you will. So I'll give you guys another example. We've seen this on 4 deals this year where the company has taken contributions, or distribution, money that the seller takes out of the business on the balance sheet. It doesn't go through the profit and loss. 4 different scenarios where the brokers added that back to EBITDA, even though it's never hit the P&L. So you're adding something back that doesn't exist in the first place. That's inflating their earnings tenfold. So I've seen that happen 4 times, and it seems like a simple concept, but I'm surprised if they haven't closed a deal by doing that before. That's why they keep doing it, is if they expect people not to catch things like that, right? People hear the word distribution and think, okay, yeah, the seller's taking $1 million out, so you can add that back. Perfect. Well, no, if the distribution doesn't hit the profit and loss, you can't add it back. Another example, CapEx. We did another deal, it's actually live right now that we're working on, where they had CapEx of $500K. And so when I say CapEx, I mean they're buying things like vehicles and machinery and equipment, stuff they need to run the business. And CapEx items go on the balance sheet. So when you buy something that's capital in nature, you put it on your balance sheet and you don't expense it. What they've done is they've bought these items, they haven't shown on the profit and loss, but then they've added it back. Another scenario where people are adding things back that are not on the profit and loss to begin with. So you can't add something back that doesn't exist. That's another scenario where they're trying to increase cash flow and labeling it as cash flow, or in this case, it doesn't make any sense to add back something that's not on the profit and loss. So understanding those adjustments, and then across the board, understanding things like run rate adjustments. What does your rent look like? Has that been normalized for new levels? What does your insurance look like? Like, as you guys are buying businesses, it's very likely your insurance premiums are going to be higher than the sellers. You guys are going to have different levels of insurance. If you guys, don't have experience in the space, things might look different than what they look like for the seller. So run rate adjustments on those and making sure that your actual financials reflect what new reality is, not what the reality was for the seller. And a lot of times a seller will say, well, no, I don't pay rent to myself, so why would that be an EBITDA? Well, that doesn't matter. If I buy the business until I have to pay you rent, and if the answer is yes, it's an adjustment downwards. That's it. And so sometimes sellers get hung up on things like that. They don't understand the point of that, and they don't understand the reason for that. So that's why having a QOV and having a QV provider in your corner who goes through all this, it's going to be material to your transaction. It's going to make a significant difference for you guys. So I'm going to kind of stop here, and I want to show you guys something else that kind of was on my mind today, on my radar as we were doing this. When we talk, I talked about construction industry being complicated. I talked about companies with deferred revenue being complicated. This is another real life example of a deal we worked on, and this is a sim that was given to us, add back analysis from the broker. This is a carve out. So I don't know. I bet most of you are not going to deal with carve outs, but I suspect at least one or two of you will. So for the one or two of you that eventually are going to buy a business on a carve out basis, I wanted to highlight this for about 5 minutes just to show you guys what can go wrong with the carve out. So when we do a QV on a carve out in this scenario, this is what the seller presented to us. They said, okay, my income is 5.3. I'm keeping 3.5. So that's the portion of the business I'm keeping, and I'm selling you 1.8. So I think that worked out to, I don't know, like about 30% of total revenue. So what the seller did, and this happens, and I know I said carve outs, this happens on carve outs mainly, but it does happen in normal deals as well. So you'll see at the profit and loss, what did the seller do? So you see the columns, right? Keeping, selling, 30%. They went through the entire P&L they had, and they allocated cost at 30% based off of revenue driver. So what they said was, okay, if I am keeping 30% of the revenue, or sorry, if I'm keeping 70 and I'm selling 30, that means I'm selling you 30% of advertising marketing costs. That means your bank charges are going to be 30% of what mine are. That's not the case. And so when you guys are doing carve outs, and so I'm kind of talking about carve outs here and deals in general, when you guys are looking at what the add backs are, you need to assess, do they make sense? And this is a perfect example. Professional fees. Okay, these guys get audits done every year. Okay, perfect. Their audit costs are 110K, and they had some add backs because they had some legal costs. So let's say 80. They've said if my audit costs are 80, an audit for me should cost 50, an audit for you should cost 26 because I'm selling you 30% of the revenue. I can promise you if their audit costs 80 and they're carving out this business, their audit after close is going to cost 75, and you as the buyer are going to cost 75. So this number, instead of being 80, goes up to 150, and it's 80 and 80. And so that's in a perfect example of where you're doing a QOV and you look at the cost allocation that the seller is providing, and the seller is going to try to do everything in their power to do things that are advantageous to them. But this is a perfect scenario where we did this deal and I looked at it within 2 minutes and I said to the buyer, listen, you are absolutely way off on your SDE numbers. I think the seller presented them 410 in SDE, and I think we came back with like 75K. Like it wasn't even in the same world.
Avnit,
And so this
quick question, if you'd be so
Sure.
kind, just could
Yeah.
you repeat? Could you go through this example just a little bit slower?
Sure.
So how do you hit 150 off of this, bro?
So for example so the seller is saying in this legal and professional fees bucket, so that 110 was their cost, and then they added back 30 in non-recurring legal, right? So 110, 30, we end up at 80K for cost for professional fees in this case. So that's what the seller pays today. I think their audit cost is like 95% of that. As an audit firm, if you charge these guys 80K for this one audit, now they're carving out two business segments, right? The new business segment needs an audit and the old one still needs an audit. Your audit costs don't increase or decrease because now you've carved out a business segment. The costs are going to be relatively the exact same. So if your costs are 80K as a business as a whole, and now you have two businesses, each business is going to be about 75K in audit costs. You might save like $5,000. So this is an example where they've taken the 80 and they said, listen, if it's 80K today and I sell you 30% of my business, your audit cost is 30K. And it's like, no, that's not the case, right?
So they should have duplicated the total cost rather than distributed it. Is that?
Yeah, you can't distribute cost. You need to have cost distributed to the correct driver. In this case, just because you're selling 30% of the revenue, your audit costs don't decrease to 30% of the total audit costs. The audit firm is going to charge you the exact same. They're going to do the exact same amount of work, right? So it doesn't change. And so this is an example where the driver is revenue. So where does this make sense? Okay, fuel expense, that sort of makes sense because your fuel expense, it's a FedEx ground business. So your fuel expense is tied directly to your revenue. So if you allocate me 30% of fuel expense, I might agree with that, or I might say, okay, that's kind of close, right? Those things should go hand in hand. But things like computer and software, it doesn't really get driven by revenue, really, right? Like if you make 100K or 50K, you don't need 10 more computers to do that. It's going to be very much the same staffing levels until you hit certain amounts. And one example I'll give you is on this client, they had one general manager that managed manage this unit. And so what they did was they took 30% of his fees and said, okay, your general manager can cost 30% of mine. That doesn't make sense, right? Like you're still going to need one general manager for each unit. Just because you carved it out, you can't take 30% of a general manager, right? And so that's an example of the seller not understanding what they're selling and how they're selling it. And so their EBITDA went from 410K to 75. And we probably do anywhere from like 6 to 7 carve-outs a year. So they're not as common, but I suspect 1 or 2 of you in this room will probably buy a carve-out business. And we've seen it far and time again that this is an example of an easy way for them to manipulate earnings or just not understand it. And this was a case where it was like they weren't even close to the right number.
So you have to calculate line by line according to revenue driver.
You have to go line by line according to correct driver. So if they're allocating 30% of revenue, you need to ask yourself, okay, what's driving my cost, right? If I get allocated 30% of revenue, do I still need one general manager? Yes. Okay. So you can't add back that general manager salary. So that's an example where you go line by line and really try to understand what's driving costs for each thing. So fuel is one where, okay, you could allocate because revenue drives that, but these other ones, not really. Like insurance, marginally.
Really
equipment rental, marginally. Exactly. So I just wanted to kind of diverge a little bit and talk about carve-outs today because I know that doesn't get touched on a lot, and I bet a little, 10-15% you might end up buying a carve-out. So carve-out, I always say get a QV, but please, if you do a carve-out, I can tell you the amount of times I've seen those things go wrong for not having it or even having one and still going wrong. It's far and too high. So that's a perfect
considering one. That's why I asked.
Okay. Yeah, there you go. Perfect, man. I knew somebody in here was. So that's a perfect example of when you're doing a carve-out, you actually have to rebuild the financials is my answer. Like you literally have to go in and rebuild the financials. You can't rely on it. Yeah.
Okay.
Exactly. And so, when we talk about quality of earnings, you can see on some deals like this one here, we had 18 different adjustments across the board, right? Bad debt is one where sellers oftentimes will say, okay, well, I had a little bit of bad debt and it's likely not going to happen again. But I promise you as a buyer, for 80% of these small businesses, whatever bad debt the seller had, yours is probably going to be 2x that. So if the seller is 10K a year on $1 million in revenue, you're probably going to be 20K on $1 million in revenue. And the reason for that is kind of what I talked about earlier: relationships, new ownership, customers taking advantage of you, sometimes employees even, unfortunately. So having an allowance for doubtful accounts or allowance for bad debt is always important in these deals, and we always allocate something to bad debt higher than what the seller has historically had. So that's kind of an important one there. As we go through QV, the next topic I wanted to touch on, as I know we're kind of pushing 40 minutes here, and I wanted to leave 15 minutes for questions. So I'm going to kind of diverge into net working capital a little bit. I talked about this being the most misunderstood part of small business transactions, and it really is. So understanding your net working capital need early, conveying it early, and communicating it correctly is the most important thing. It's not a complicated calculation to make for the most part. Some companies are if you've got WIP and other things, but I will say for sellers to understand it, they cannot wrap their heads around why they need to leave working capital. And so if you're buying a business and you're buying it on a strong multiple, the expectation is that you are leaving working capital in the business for the buyer post-close. If the seller is not, then you should not be paying a multiple of 4 to 5x. Because frankly, you're going to need to outlay another $1 million in working capital often. In this case, for example, this business we did, it's $1,445,000 in the T12M. So we always look at an average of the past 3 years, then we look at trailing 12, trailing 6, and trailing 3. Growing businesses always need more working capital. Shrinking businesses, okay, you start to see it decline. So depending on if you've got a growing business, if you've got seasonality, if you've got a shrinking business, how much working capital left behind always changes. And it's important to note, a lot of times sellers go to their CPA to make working capital calculations. Their CPAs are going to be tax guys that come in once a year to help the business. They're not going to understand what net working capital is from an M&A perspective. And why is it different? In traditional accounting and in traditional CPA, when you go to school, you work at firms, you learn working capital is current assets minus current liabilities. So if you think of let's say you have a line of credit. A line of credit is a current liability. A seller is going to take that and say, oh, listen, I've got a line of credit for $1 million. So actually my working capital need is 0. And I've seen that happen on a deal. It was a pretty big deal too, where the seller's CPA put together a net working capital calculation. And we said it was 2.5 million. They said it was 0. And I looked at it in 2 seconds. I figured out the mistake. They put all their debt as current liability, their lines of credit. When you're doing a working capital calculation for M&A, you have to make sure you're doing it cash-free and debt-free. So no lines of credit, no related party loans, no shareholder debt. All of that needs to be removed. And you need to figure out, what does the business need to run without any debt, without any cash? That's the net working capital number. And that's where your peg is going to be. So in a scenario like that, we were $2 million off because the seller CPA had told them, hey, if you leave back these lines of credit, you've got no working capital need. And I promise you that's not the case. Earlier, we talked about businesses with deferred revenue having manipulative EBITDA figures. They're the hardest to do cash to accrual. But if you have businesses with high deferred revenue, you have a strong working capital cycle, because generally that deferred revenue funds your AR and funds all of your purchases. So understanding the nuances, cash flow timing, you can be buying a massively different business depending on what your net working capital looks like. We did a business, another sort of case study here, that was a year and a half ago. It was a nurse staffing business. So they get paid from the hospitals and they pay their nurses weekly. Well, lo and behold, on their P&L, they have a factoring expense of $600,000 for the year, and they've added all of that back. And you need to ask yourself, why do they have factoring? Well, they pay their nurses every 7 days. The hospital pays after, I think they had 120. So what's your working capital hole? 130 days that you have to fund these nurses' payroll for before you see a single dollar. So they couldn't do that. They didn't have the cash flow to do that. So they had to pay this factoring company $600K of their SD and EBITDA in order to fund the operations. So that's an example where that business's working capital need was like $4 million probably in order to fund the cycle. And if they didn't have that, well, they were always going to have to factor, right? We did another deal recently. It was another aerospace company, and Honeywell is one of their biggest clients. And Honeywell had 180 days, 100 net 180 on all their invoices. So you can imagine, like, if you only have to pay twice a year and you have all this work going into these guys, like, you have 6 months of costs you're carrying before you see a dollar from your customer. And so when you're carrying 6 months of cost, you have to ask yourself, can you carry that with the debt you have on the business if you don't see a dollar from your customers? Most often the time, if you're leveraging at 1.3 DSCR or 1.40, your answer is probably going to be no, right? So that makes the business look very different than what you thought the business was going to cash flow. So EBITDA is one thing. EBITDA plus net working capital, that's cash flow. So understanding how those two things work together is an important part of a QV. So as much as we talk about adjusted EBITDA, understanding your cycles is going to be very important, and understanding cash-free and debt-free, what that means to you, is going to be very important. So as we go through, you can see the cash conversion cycle in this business is about 60 days, which is actually average about 40-50, which is pretty good in the case. And so what your working capital conversion cycle is, and if it's good or not, is really dependent on your business and what environment you operate in. Some businesses, this is amazing. Some, this is terrible. So really having a QB provider that's done deals in your space before and can leverage other resources in order to be able to say, hey, I think this is good, or I think this is poor. It's going to be crucial and important to you guys' deal and the success of it ultimately. So as we go through net working cap, revenue, and understanding gross margin, and understanding all your revenue sources, all your revenue streams by revenue segment is just as important as well. You need to understand where your revenue is coming from, what are the cost drivers for my revenue, and how is it going to be broken out, and what are my costs going to look like post-close. So understanding all of that, having it explained to you, looking at things like the quality of the assets and all of that. So I say that to say the QV has a lot of stuff in it that makes things material. I'll give you guys another quick live case study. We're working on a deal right now on the income statement where they presented 700K in SD or EBITDA, but 200 of it 200K of the revenue came from a customer for which it was a church for which a seller goes to, and he donates like 250K to that church every single year, and they're 200K in his revenue. So my question to the buyer was, okay, is there any guarantee that customer stays or leaves with the seller? Because that's a substantial part of your business, and it was a growing revenue stream. I think it was the third largest customer. And so that's something where if you see some sort of related party transaction, and even though it was legal and it was fine, and it's actually the seller's true EBITDA, the seller's EBITDA is not yours. And so that's where it becomes different. Understanding where that line is drawn and how you are going to run the business versus what the seller is. Because really our QV, we always try to look at historic EBITDA, but we look at historic EBITDA in the lens of if you were the buyer. We don't look at it if the seller was a seller's owning a company. Like, I don't really care what the seller made. I care if you own this business for the last 3 years, what would you have made if you had these same relationships and you had the same network as a seller and you had these customers? What would you have made? And what are you likely going to be making going forward? Like, will this customer leave? Is there churn? Where is the churn? Is there a risk with increases in customer revenue? And anecdotally, I could tell you guys, in 2025, the business environment looks a lot different than it did 2 years ago or even last year, to be honest. We're seeing softening of revenue and EBITDA across the board. I haven't really seen multiples drop too much, unfortunately, but in the last month, we've seen increases in earnouts and forgivable seller notes when they were very popular post-COVID, and then they kind of slowed as valuations and earnings kind of met. But now they seem to be growing again because there's an increase in valuation expectation and actual earnings and revenue. So I think as you guys look to navigate the market now, you guys are going to have unique challenges with most companies, not all, struggling and kind of, not really being as strong as they were historically. And really SMB and smaller businesses in the lower mid market, they face the tailwinds of macroeconomic environment first and before it goes up to the big players. And so understanding the environment you operate in, and right now especially, every time we do a QV, I always ask the buyer, who are your end customers? Like, what's their macroeconomic environment look like, right? If we're doing a deal and my top 5 customers are these developers, let's say, and I'm doing construction businesses, I say, okay, what are these developers next 5 years look like? What's their pipeline? And so really you guys need to go one step further, I think, in this case, and ensure that the business you're buying, your end customers, what's their future look like? Is there any transaction on the horizon for them? We did a deal where a customer churned for a seller, and I asked the guy, like, what happened? He's like, oh, they got bought out. And that was their 4th largest customer. I'm like, okay, what if a buyout happens again this year for another one of these guys? Then what does your EBITDA look like? And it's dramatically lower than it was presented, right? So even though EBITDA is one thing, having the qualitative and the narrative around all of the adjustments and understanding all of that it's just as important, if not more important. So I know we're kind of at the 50 here. I'll open it up for questions. Andy, I don't know how you prefer to do it, but I'll open up to questions at this stage.
Well, yes, feel free to send your questions in the chat, or maybe just ask your questions to Avnit.
Sure.
I mean, really helpful. I guess on that macroeconomic observation you make, what are some additional kind of coping strategies? I mean, it seems like you'd have to be even more on point with these quality of earnings considerations. Like you say, looking into the value chain a bit more, into their customer base. What are some other thoughts you have on how to deal?
Yeah, absolutely. I honestly, I think the first thing I do is I just Google the customers. And so it's easier when you've got well-known customers. And I'll give you an example. We did a deal for a customer or a client that bought a business, and the business does residential or like painting, or I guess for large projects. So they talk like in South Florida, like 1,000 homes. They'll do like the painting on those, right? So the first thing I did was I went and looked at all these developers and I said, okay, what's their pipeline look like for the next 3 years in terms of projects, and which projects are we guaranteed revenue on? And what are the developers that are like, okay, like this project might be slow on pre-sales, or they might not be selling a lot of units. Well, do we need to worry about their liquidity, right? So I think the first step I do is I look at the customers and I see first thing you assess is churn and trends. Okay, are there any customers churning? Are there any customers increasing or decreasing in percentage of revenue, so concentration. And then from there, sample the customers that you think are higher risk. So it's usually your top revenue customer, your top 5, your top 6, your largest increased ones, and understand, like, are there contracts set in place with them? We did one, it was another aerospace one, where I saw they had massive increases with 3 customers, but then they had you sort of see, okay, well, they locked into a 3-year contract until 2027. So the buyer's comfortable until 2027, knowing all this work is coming in. Now, once 2028 hits, that might be a different conversation, but I think their risk appetite is willing to get them to 27, right? So understanding, are there contracts? What's their environment? Are they susceptible to tariffs? Are they susceptible to drops in the labor market? Are they susceptible to drops in shortage of labor, right? So I think it's like a whole approach, and I think depending on the industry, depending on the customer, how you go about it is a little bit different. So it's really, at the end of the day, it's just working with somebody and working with a group of people who are going to get you that answer.
That's good. How would this vary with digital specifically?
So when you say digital, are you talking about like kind of like digital advertising, or like?
No, yeah, like just digital businesses, like, SaaS, content membership, this kind of thing.
Yeah, absolutely. So I was talking to somebody today, and we're like a affiliate marketing company, and we've been seeing drops on revenue for PPC, like pay-per-click ads and things like that, because of Google algorithms. And so it changes when you break it down by revenue stream, and you look at, okay, like, what's my MRR, right? MRR for SaaS is like the holy grail. What's my gross margin for SaaS supposed to be? It should be like 80 to 85%, depending on the industry. They're usually SaaS businesses are notoriously high for having good gross margins. So understanding kind of the trends on their revenue is the most important part. And then saying, okay, like, if they have churn, why is it churning? And what's their customer acquisition cost? What's their lifetime value of a customer? How much do they need to spend on advertising to generate that revenue? So kind of their ROI on ad spend. So using different metrics that are industry specific are going to matter in this case. And like, those are some of the ones I would look at for digital. And then MRR is going to be the holy grail for SaaS, right? MRR and gross margin, and just making sure those stay steady, and making sure you're not getting hit in a business with AI or algorithm changes. And like the one I said, like PPC companies that do PPC ads are getting hit significantly because of changes in their operating environment. So ensuring all of that kind of checks out, it's probably going to be usually the biggest kind of source we look at.
Yeah. And you do do you do the kind of the same amounts digital and analog deals, or how does it split for you?
Yeah, you know what? We usually do touch most industries. I can't think of one we haven't at this stage. So we, it's more deal size than 1 to 50, 1 to 75, but most industries we touch. And over the last 4 years, we've probably have seen, I don't know, everything that most buyers here would buy.
Do you also do home health?
Yeah, we're doing a home health business right now, and it's actually a pretty big one. It's 3.6 in EBITDA. We have our first seller call this week, so we just kind of starting it. We did a home health one in Florida last year. So those are the 2 that I can think of. I think there was one more in the mid last year as well.
Was it more like cash pay type home health or Medicare, Medicaid?
Yes, it is a mix of both. So the one we're starting now, we're still digging into it. The one we did last year was kind of, I believe it was a mix of both. I can't remember. I got to check the manager on it. But we've got the data. I don't touch every deal, but we've done, I think, 4 home health fairs in the last year.
Okay, thank you.
Is there any area or industry that's maybe proving more resilient to some of that macro environment you're talking about, like within essential services, maybe home health? What are your thoughts?
Yeah, I think, like, usually like HVAC was the one people would say, okay, well, it's pretty susceptible or pretty resistant, I guess. But we actually working on one last month which had softening earnings pretty substantially, so I can't even say that now. There was another one, they had city contracts for sewer cleaning. That one's taking a bit of a hit. The one industry where we've seen, and the reason I say this is because we're doing 2 live deals on this, and I think I talked about aerospace a little bit. Aerospace MROs have tended been pretty strong. We did a sell side queue in an aerospace MRO. They do distribution and repairs, and we did it in March or April of this year. and they were at 5.2 in EBITDA. They've come back to do a true up on that QAV, and they're kind of at 6.5. And then the other business we're working on the buy side, they went from 800 to 1.3 in the TTM versus TTM that was ending in March. So aerospace MRO seems to be pretty resilient right now. And I think, like, you know, the end customers are Boeing. They work on one of them does only Boeing, and they do one Airbus model, but they've been pretty resistant. Another industry that I'm trying to think on the top of my head what we've got in the pipeline. Yeah, like even the millwork cabinetry business, historically they've been pretty good, but they've taken a bit of a hit. We did a paving business that took a pretty massive hit. The home health one actually seems like it's going to do okay. The one we're working on now, so far things look like they're checking out. So I think it's a mixed bag across the board, and there's no one answer. I mean, the aerospace ones have been hard, but outside of that, every other industry seems to have some sort of decline in it.
I mean, do you think that presents an opportunity in a way if you can kind of make the argument for the lowered valuation, even if you're saying it's not lowering on its own accord right now?
Absolutely. It creates this is where deal structuring and creativity present an opportunity, right? If you're willing to, like the HVAC one I was telling you about, they had earnings softening and our buyer presented some sort of creative on a larger forgivable seller note, and the seller wasn't on board. The cabinetry millwork one we're working on, we've increased the seller note by like $1.5 million, and I think we tied $1 million in forgivable to certain revenue metrics. And so it creates an opportunity for you to buy a business and really buy it at a low multiple if the earnings don't work out, or if they do work out, great, and then you pay the seller. So I think there's an opportunity for earnouts and larger forgivable seller notes, and I think sellers are more open to that right now, and I think brokers are even kind of more open to that conversation than they've been in the past. And so kind of a mix of deal creativity, I think it creates an opportunity for.
That's good. Yeah, thank you.
Cool. Does anyone else have any questions for me here?
Do you also do like tax due diligence as well, or no?
No, so we don't do specific tax diligence. We take the tax returns and then we do a bridge to the financials, and we make sure, like, we always look at the tax returns and make sure they check out and make sure they match the bank statements and they match the financials.
Mhm.
But we're not going to do specific tax diligence in the sense we're not going to check with the IRS, have they been remitting right, look at their sales tax. We usually don't look at any of that stuff.
Okay, cool.
Usually those tend to be, you can go to the tax person you're going to use post close, and they'll just kind of do it for you for a few grand, or depending on how complicated their tax structure is, if they've got international and things like that, okay, then it gets complicated. But for most US based businesses, it's generally not a massive complexity, I guess.
Okay.
Cool. Well, if there's nothing else, Andy, I'll turn the floor over to you.
Yep, well, it was a very insightful session. Let's bring this home, and thank you so much, Avnit. And if ever you would like to reach out to Avnit, feel free to reach out to me as well. I'll be sharing his contact information and this presentation as well. So, yep, feel free to let me know if you do have any other concern as well. Thank you for spending your time, and we'll see you on the next call. Thanks again, Avnit. We appreciate that.
Thanks, Avnit.
Thanks everyone for having me, listening to me talk about QV. If you have any questions, reach out to Andy. I'll give you my contact, and we can talk from there.
Thank you.
Yeah, thanks all.
Thanks.